Well, hello everyone, welcome. First of all, I'd like to acknowledge the traditional custodians of this land whose cultures and customs have nurtured and continue to nurture this land since the dream time. In my case, I'm in the land of the Gadigal people of the Eora Nation, and I pay my respects to elders past, present and emerging. Welcome to the second of three seminars in a webinar format. The format for all of these webinars is for a talk of roughly 30 minutes with questions to follow. Please ask your questions via the Q&A section of this webinar, remembering you can vote for questions you like to put them towards the top of the queue. I'll be putting as many of these questions as I can after the presentation. Today we're going to hear from Slava Platkov from Dimensional Funds Management. Slava is also a lecturer in our Master of Applied Finance program and joins us from Sydney. Welcome, Slava.
Hi, Lindsay. Thank you for having me and welcome everyone. Apologies again for a slight time delay. The product of living in this virtual world is that you are going to, have some technical difficulties at times, but that's all right. We can move on. So today, as Lindsay said, we are going to talk about data in sustainable investing. One second, let me just. I work for Dimensional Fund Advisors. I'm not sure how many of you know about this fund manager. We've been around for 40 years. We're a large, we manage about $700 billion globally. Been around a long time, and we are what is now called a factor-based manager, or we employ a factor investing approach. It is a systematic approach, which is what we're talking about today. And systematic, again, for those who don't really know, it's really around systematically focusing on the type of stocks or bonds that you want to maintain exposure in your portfolio. So rather than your typical traditional stock picking or bond picking approach where you're researching companies, a systematic approach is one where you are systematically gaining an exposure to a specific type of a company or specific type of a security. And the type of a security is where the research comes in, the type of a security is where the data becomes really useful. Sustainable investing comes with a specific data set, a data set that is focused on whether companies operate sustainably or not. And that's something that we're going to explore today. So we at Dimensional, we've been actually offering a solution that takes some level of sustainability for quite some time now, probably for over 30 years now, where, for example, we had a South African client back in the 90s that instructed us to exclude tobacco stocks from their global equity portfolio. So that's a form of sustainability. Around 6 years ago, we have launched a suite of sustainability portfolios across the world, equities and fixed income. It's been incredibly popular, this approach, and one of the reasons why it's been popular is because it ticks two boxes, and this is something that's very relevant for this presentation. The first is that this approach looks to first and foremost maintain the return integrity, maintain the quality of the investment solutions, because you don't want to be jeopardizing the return of your portfolio. But at the same time, this suite of portfolios, in addition to being a really good return proposition, these portfolios are also accommodating that really strong desire from investors to invest sustainably. And so it's kind of that dual objective that makes it really popular. And one of the reasons why we've decided to launch it 5-6 years ago, this new kind of suite of portfolios, this new approach to sustainability, is because we kind of considered that data was finally ready enough. The data on sustainability was finally at a point where even a very conservative, very thorough fund manager like Dimensional were kind of happy enough with the quality to actually use it to accommodate those two objectives. And that's a good place to start, objectives, and that's what I'm going to talk about today. To start with, what problems are we trying to solve? Because it's one thing to address data, to talk about the quality of data and what it means, but ultimately you want to be doing something with that data, right? So we're gonna, and that's really where it all starts. So we want to lay those problems out on the table. and see if the data is good enough, the sustainability data that we now have access to is good enough to solve those two. Then I'm going to give you a bit of a demonstration as to the data that we work with and kind of the format that it's in, and obviously the many challenges and the many inconsistencies that are still in the data, and obviously decisions that we as fund managers have to make when we are using this data in our portfolios. And then finally, I want to allude you to the fact, or reaffirm the fact, if you like, that ESG is something that's been around for many, many years, decades in fact, and there's been an enormous amount of academic work that's been done in this field. Obviously, when you're doing research on ESG, whatever you're trying to achieve, there is a data element that comes with that, and so it's been around a long time. And I'm going to kind of take you through some of the more recent and some of the more cited research that's been done in this area and some of the conclusions that have been made as a result. All right, so let's start with the first one. What problems are we trying to solve? That's very much a cup half empty kind of a question. If you were a cup half full kind of a person, you could rephrase that as, what objectives? Well, what are your investment objectives? When you've got a new set of data like sustainability, for example, what objectives are you trying to solve? And the first one is an obvious one if you know anything about systematic investing. Systematic investing, as I said, we're all about finding reliable information about what drives future return. So we're all. Is there something that we can gauge, whether it's from a market price or from a set of fundamentals, that can tell us something about whether a particular security or a particular group of securities are going to perform a certain way in the future? And if that information is reliable, then we can obviously use that in our portfolios. We can systematically maintain focus on that group of securities to then outperform. They're the fundamental roots behind systematic investing. And if you look at in terms of where would you start looking for that information, I think this valuation framework that you see in front of you there is a really good place to start, because what you are trying to get at is that discount rate. You're trying to get, that's that expected return. And if you want to look for things that drive that expected return, or that you really ought to start with price and cash flows. That's where you've got to start looking. So then it becomes an empirical exercise, which is what systematic investing is all about, really trying to test a whole bunch of price-based variables, a whole bunch of cash flow-based variables to see whether there's something in those variables that tells you about expected return. And that's why, the three kind of most known premiums or factors out there are size, value, profitability. There's a whole bunch of others or versions of these that are out there. When there is a sustainability data, when there's a new set of data that come through, what you want to do ultimately is you want to essentially carry out a similar exercise. You want to know whether there is a way, or there are sustainability-based metrics that you can compare companies or securities on. It doesn't have to be just stocks, it could be bonds or what have you, and whether that set of data allows for you to say something about future return. And what you want ultimately is you want whatever it is that you find, you want to be able to control for the things you already know, which is in front of you now. So size, value, profitability, and the question, the objective or the problem that you're trying to solve from a return standpoint is the sustainability data telling you anything else about return outside of what you already know, right? And we're going to have a look at it. We're going to have a look at that. And the second objective is again more about sustainability, and this is a really important one. Whereby you have it's much more challenging when the objective is something so subjective like sustainability. What you want in systematic investing ultimately is you want one metric. You want one metric that is transparent, that is continuously updated, that everyone understands, something like a price, and you could compare companies on that, and then you could go and do something in your portfolio about that. When you're talking about sustainability, we're talking about many different preferences. It's all well and good when a South African client is asking you to exclude tobacco stocks, but when you're managing a portfolio for thousands of investors, and you could see that there are so many things in front of you there are so many different things that those investors may have a preference for, it becomes it becomes a challenge to systematically capture all these preferences in the portfolio. But nonetheless, that's why you have to understand the data that you're working with. That's why you have to make some decisions around what is the main priorities, what is it that people are trying to first and foremost prioritize when they're thinking sustainable, and you're trying to accommodate those preferences. And there is no doubt that in terms of popularity, sustainability, ESG, SRI, whatever you want to, whatever name you want to call it, has been incredibly popular. This is GAM, but any funds under management survey that you may look for will show the same trend, in that this sustainability is super popular, super topical. But with that, it comes a risk, and as anything else in life, whenever things become popular, that popularity generally comes with a lot of products. Popularity comes with a lot of products that are being managed in a very suboptimal way, a lot of aggressive marketing, which is risk for investors who have a very good intention of investing sustainable. They're clearly very passionate about this, but then they end up being in portfolios, in solutions that are probably being managed in a suboptimal way. So let's have a look. So that's the backdrop, a bit of a preamble as to what we're trying to do here in terms of the two objectives. Let's now have a look at what we're working with here. All right. So data. So the data providers. So again, systematic investing, certainly from our perspective, ultimately we're not in the business of researching companies. We are a data consumer. So like I said previously, we would love to have a set of data that we can absolutely trust. Unfortunately, it's not as easy as that. That's why when you're looking for a data provider, and there are many data providers when it comes to ESG, there's a certain criteria that you must kind of scrutinize and you must be very comfortable with. Some of the things that we look at, some of the things that are really important, is credibility and commitment to the space. That's the first one. So we work, as you can see there, we work with MSCI and ISS. ISS is a more recent addition, and I'll explain to you why. MSCI is certainly credible. They've got a separate business, if you like, separate team of people, a large team of people that's been around for a long time, that is clearly pioneering in the space of, producing relatively high quality data around ESG for companies, for a whole bunch of companies around the world. So clearly credible, been around a long time, lots of people, a clear commitment. And ISS is another one that's like that. And there are many other providers that stack up as well on this particular criteria, but you obviously need to choose some, and that's why MSCI and ISS are the ones that we went with. But in terms of commitment and credibility, that's a really important one, particularly for an area like ESG, which is obviously an area that many investors are very passionate about. Coverage is another one. So this is around the amount, and this is really important. This is around how many securities they cover. I will show you some evidence in a few slides' time that it's a really important area. You want obviously more coverage. There is an element where, when it comes to coverage, there's an element that the actual company plays, and there's a lot of motivation and there's a lot of encouragement for businesses to disclose their ESG practices and the risks associated with those. But what you'll see is that many companies fail to do so. They fail to report, they fail to measure, because it costs to do so. If you're some small cap company that's trying to survive, growing their business, you're not going to spend a lot of time you're not going to spend resources thinking about how much emissions you're extracting into the atmosphere. That's going to be a secondary consideration for you. So you need these providers here need to come up with a really good process that somehow covers for those companies that don't want to disclose these things. Okay, now frequency is another one. So these companies, these companies, how often they update that data. So it's one thing to analyze a business, MSCI, for example, analyzing a business and measuring the carbon footprint of that business, but it's another thing is how often they go about doing that. And that obviously has implication for your portfolio as well, because if the numbers are changing, that means your portfolio is changing, that means you're incurring turnover. process for companies who fail to disclose. That's something that I spoke about when we spoke about coverage. That's something that is, if you're a systematic manager that's involved that using ESG data, you need to get your head around how the company goes about measuring scope 2 emissions. I'm assuming everyone knows what that is. Basically, companies that consume electricity, which is most companies. You need a good methodology around that. So you need to understand how MSCI go about measuring those things, how ISS go about measuring those things. That's really important. Process in terms of how whether is it do you employ a whole host of analysts that are going out there researching these companies to come up with this ESG data, or do you outsource some of that to third parties? So MSCI, for example, they employ something like a team of 30 analysts around the world that are doing this type of work, which is really important, because not only is it likely to result in a better quality data, but it also means that there are people that we can contact and again question about some of the stuff that they're putting out. ISS, for example, a company called CDP. They're a third-party, non-for-profit organisation that's clearly very passionate about measuring carbon footprint of companies, so they use their research as well. So there's various things you could do, but you need to understand those. Transparency is really important, and we'll talk a little bit more about that in a tick. But you need to understand what data that you're getting and you're using in your process, and you need to really understand every detail of it, because if you're taking the responsibility that you're managing someone else's money seriously. And finally, responsiveness. You want to provide feedback to these data providers, and you want to see that feedback is being taken on. All right, let's have a look at some of the data that we use in our process, dimensional, but also some of the data that's out there. So I'm just going to use the ASX 300 for now, because that's obviously a universal stocks that most people are fairly familiar with. So we've got the ASX 300 universe. The focus certainly, and again, this goes back to our conversation about you need to prioritize something that's most important for your average investor. And there is no doubt that carbon footprint or carbon risk, whatever you want to call it, is by far the biggest issue out there. So greenhouse gas emission intensity is the metric that we use and that most of the other systematic managers use. The other things that are of focus are things like reserves. So you may not be a business that's emitting into the atmosphere at this point in time, but you may have the reserve that will do so in the future. So you want to be sure that you want to sort of capture that as well. Other focus areas with respect to environment are land use, biodiversity, toxic spills, waste, and water management. Now, really important here is to differentiate between if you're a systematic manager managing these portfolios, you need to get the raw data from the data provider. There are managers, there are products out there that are using ratings. So, because MSCI, ISS, Sustainalytics is a really popular one, a really large business that produce ratings. And if you're using ratings to form your portfolio, that from our perspective can result in to be a bit of a problem, because you don't have a lot of transparency around how these ratings are actually put together. And the way these ratings are actually put together can result in it could change from time to time. So your portfolio, that means your portfolio will change. Sustainalytics, as an example, they have an approach where they use 20 different kind of measures that fall into a sustainability rating for every single company. And the weight of those 20 within a rating is different depending on the industry you're in. So there's a lot of there's lack of transparency from our perspective. These are the decisions that we want to be able to control, because it is our responsibility. Ultimately, we are managing someone else's money. So when you're working with a data provider, the first thing that you want to do is you want to make sure that you can get your hands on a set of raw data rather than ratings, and then you want to understand where the data comes from. You want to be able to clean it. You want to be able to pipe it through your systems and use it in your process as you feel is appropriate. But from an environmental perspective, that's the focus: greenhouse gas emission intensity, and this other four things there. So this is just a really small number of just randomly chosen number of companies that you're probably all familiar with, listed in Australia. And what I've got here for you is I've got MSCI and ISS, and I've got greenhouse gas emission, which this is what this company's emissions are, and intensity, which is basically greenhouse gas emission divided by sales. So that's what we choose to scale it by, sales. That's another decision that you've got to make. You can see a very important here is to have the source. So reported means that the company is actually reported that number, and MSCI simply went and extracted that from the financial statements. But for example, this one here is a situation where ResMed failed to report a greenhouse gas emission intensity number for this particular period. So the CSI stands for company specific intensity, which is where MSCI would go and essentially extrapolate based on previously reported numbers and based on kind of as a proportion of revenue or sales, whatever that may be, that would extrapolate the current intensity number. So that is the type of stuff that you absolutely need to understand, because that is the type of stuff that can lead to changes and therefore turnover in your portfolio, which you don't want to incur if you don't have to. All in all, and the same thing goes for ISS. You can see that numbers are relatively similar; they're a bit different. Very importantly, is that when you look at greenhouse gas emission intensity, the order of numbers is the same, right? The value might be a little bit different, but the order is the same. Why is that important? Because when you're managing money systematically, when you're a factor-based manager, it's all about the ranking, where a particular company sits with respect to other companies in that universe. That is what you're trying to capture in your approach. So the order is very important. So that's sort of what the greenhouse gas emission intensity data looks like. And then over here, I've got a similar, the same set of companies plus two others, Newcrest and Woodside. Again, what I've got here is the other considerations when it comes to environment. So potential emissions, we spoke about that. That's basically stuff in the ground that's not being dug out yet, that might become, that might harm the atmosphere in the future. So we want to be able to quantify that, which is what we rely on for MSCI to do, and we want to make a decision whether that warrants for us to downweight Woodside Petroleum in our process, whether it warrants for us to exclude it altogether. Then what I've got here is this other four really important environmental considerations: land use, toxic spills, waste and water management. And as far as the data goes, the process that MSCI and ISS do something pretty similar. The process that they carry out to quantify these risks, these environmental risks, is, as you could see there, they start with a number 10, and then they penalize a company if this company has been cited over some recent period to have been cited to carry out in these activities. So Rio Tinto, as you could see there, clearly they've had some toxic spills, etc., which obviously penalizes them from 10 down to 5, and that has an implication on your portfolio. So again, you need to understand as a portfolio manager, you need to understand how these data is being created, how it's being quantified, how it's being used in your portfolio, and how frequently it changes as well. So all these things are really important. So that's environmental, and the quality control plays a really important function when you're managing money using sustainability data or any other data for that matter. And what we've noticed is that there remains an enormous amount of inconsistency still in sustainability data. So for example, just from a coverage standpoint, you've got MSCI. This is just looking at greenhouse gas emission source. These are the different sources. So reported obviously means it's in the financial statement. And while 83% of the ASX 300 you can get from financial statements, which is obviously a pretty reasonable number, it's only 130 companies. So there's 170 companies that MSCI have to go and model out in terms of getting that greenhouse gas emissions number, which is a pretty large amount. And in terms of the different ways we'll talk on the next slide about the different methodologies they have in terms of how to model that number. And again, that's something that is important to understand. ISS have lower coverage. So you could see here that annual reports, that's the main one for ISS. That's the same as reported for MSCI. I'm not quite sure why ISS can't get to that same market cap, but what ISS is good at, and this is something that this is one of the reasons why we've added them to the lineup of providers that we're working with, is they actually, all these 170 names that MSCI don't cover well, they tend to be smaller companies, as you could probably gather from the large market cap number. And actually ISS do quite a good job, whether it's through CDP, which is that non-for-profit organization I spoke about, or through other modeling. They actually do quite a good job covering those companies that MSCI have to model. And that gives us a sanity check, and that gives us some further confirmation about whether this data is of quality. But overall, you can see that while these data providers, the two main one anyway, do a pretty good job covering the universe, so there's still many inconsistency and many holes in the data set. And that's really important. For example, ISS here, there are 40 companies that are blank, essentially, when you take their SEC 300. So that's something to take out. And then there are inconsistencies in the actual data. So take the four largest banks, pretty similar companies all in all. You could see that while Commonwealth Bank, Westpac and NAB, they're all pretty consistent in terms of the greenhouse gas emission intensity. You could see that for whatever reason, ANZ, there's a discrepancy between MSCI and ISS in terms of what they're reporting. So that requires a portfolio manager or a data team. We at Dimensional, we have a very strong data team. I understand this data to the point that the portfolio manager is supposed to understand this data, how it's coming into my portfolio, how it's being used and what it's doing to my portfolio. There are people at Dimensional that obviously know a lot more about these numbers than I do, which obviously I work with very closely, and I would speak to those people to question these type of discrepancies. And then there's obviously a whole different level of people, people like scientists that understand these things to a whole different degree. But these inconsistencies are definitely an issue. I've got Bendigo Bank and Bank of Queensland, two second grade banks that are pretty similar businesses, but for whatever reason, you could see here that the intensity of Bendigo is much higher. And plus whatever they scale it here doesn't make sense as well. Insurers, you've got IAG. If you look at IAG, MSCI, ISS, for whatever reason, ISS is showing that the intensity is much higher from an ISS's perspective than it is from IAG's perspective. And there's various other inconsistencies. What this is basically telling you is that this, again, going back to the very start, where you're looking at a piece of information that is fundamentally very subjective and difficult to measure, and not every company has the resources to measure it properly. We'll talk about that in a second, but what that means is that there are going to be more inconsistencies with the data set that you're working with than, for example, a data set of fundamental data, say, earnings numbers or book values, where the accounting standards have been around for a long time and there's a fair bit of confidence around how their things are put together. What that means is that from a process perspective, as a manager using this information, you need constant oversight. You need processes in place that are looking at these numbers all the time, that are trying to find, when trying to pick up instances where these numbers change significantly. And obviously you need some really good things in place, constant things in place that are telling you that something's going on with your portfolio. You have to have a look at this number, and that's very important to have. So that's all part of the consideration. This is how MSCI looks at this. Basically, this is how MSCI addresses situations where the data is not reported, and greenhouse gas emission intensity data is not reported. So they've got this production model, which is a fairly something that's been around for a long time. There's two ways to do it. So ISS have one as well. So production, MSCI use a location. I'm not going to write the word because it's difficult. They use a location methodology, which is basically, if let's say you're a Commonwealth Bank and you own a building and you buy some electricity, you basically, the amount of emissions that building is going to be captured in terms of the greenhouse gas emission intensity data is going to be based on the location where it's in. So they're going to take the average of the grid that building is situated on, and that's the number that they're going to assign to that building in terms of emissions. Whereas, for example, so that's just a methodology of how, that's a production methodology that MSCI use. They call it a location methodology, whereas ISS use something that is called the market methodology, which is where the Commonwealth Bank would go to whoever they buy that electricity from. This is scope 2, obviously, buy their electricity from, and actually ask them about how the electricity was produced and how much emissions that production involved. So that's called a market methodology for ISS. So what you want to be doing as, again, a data consumer, as a fund manager that uses this in their portfolio, you want to try and get providers that use different methodology, and then you want to obviously compare one to the other to see which one works better, to see which one is inconsistent. And then, as you could see there, if there is no information from production, they use a company-specific intensity model, which is where they, as I said, that was the case with ResMed, which is where they use previous numbers. And if they don't have that, if they run over previous numbers, if the company has never reported, and there are many instances like this, as I said, the coverage is nowhere near 100%, then they will essentially estimate the emissions number for this business if from other similar businesses in that particular industry. So there's a process in place. It's just important to understand it. All right, so that was environment. Again, like I said, it's very important to get the raw data and to ideally split environment from social, from governance, and then come up with your own methodology in terms of how to use it. The things that there's from a social standpoint, there are literally hundreds of considerations that people are concerned with when it comes to investing socially. What you want, again, is to come up with a list that encompasses your average investor, and that's the list that you see in front of you there. There's roughly a dozen, 8 to 10 things, 8 to 10 issues there that you want to be covering, and they generally cover most people's preferences when it comes to social investing. Very importantly, some of them are used as a percentage of revenue. So, for example, alcohol is, if you basically define a particular threshold when you're using this data, and this data is fairly readily available from financial statements. So you go to an alcohol provider, and you find out how much revenue as a proportion of overall revenue they're generating from sales of alcohol. And if it's over, say, 20%, then you might want to think about either downweighting that company in your portfolio or excluding it altogether. So that's pretty straightforward when it comes to alcohol, gambling, adult entertainment. Where it actually, this child labour should probably sit in there as well. Where it becomes a lot more subjective is things like factory farming, child labour, cluster munition. This is all about citation, because this isn't something that companies necessarily want to divulge or report on, and in fact they're motivated not to do so. So you need to really do some research, and that requires, again, resources. And in fact, Dimensional, we spoke with MSCI extensively about this particular research in this, factory farming, palm oil, child labour, and we actually came to the conclusion that the research of MSCI was inadequate when it comes to these three things, and we decided to kind of internalise it. So we hired some people that are now carrying out this research internally. So that's really important as well. So again, you need to understand what resources, what efforts do these data providers have in place to make sure that not only are they covering things like child labour, factory farming, how they're doing it, and how often are they refreshing their research, what sources are they using. So all those things are incredibly important. Whereas from things like alcohol, gambling, adult entertainment, that's a percentage of revenue. That's quite straightforward to do. But a fair few decisions to make there from a social perspective. And this is how kind of the world looks, if you like. This is MSCI World Index, and this is these social issues that you want to be screening out. Our process, it's black and white. If you fall into any of these buckets, if you screen for any of these issues, you're out of the portfolio, but many different approaches use different methodologies, which is fine. But you can see also here, this is again an issue of priority, an issue of thinking about the bigger picture of what you're trying to achieve from an overall portfolio standpoint. In Australia, you're only talking about 13 companies and 3.5% of the index. So, how much time and how much effort should you be spending screening for these particular issues, given that it's not going to have much of an impact on your overall portfolio? So that's also a consideration from a business standpoint. MSCI, it's obviously much larger than that. So it's a proper issue. Some of the things, and also this list is constantly changing. So some of the things around nuclear weapons are fairly personal firearms. That's something that's come into the portfolio since the New Zealand shootings, and so there's things you actually need. It's less data intensive. You need a set of people that are always watching and reading about these things to make sure that you're up to date in your portfolio. But hopefully that gives you a bit more color around what the data looks like in terms of environmental and social. Now, let's just quickly reel off some of the challenges, a lot of the things that we've already spoken about. So when you are trying to, again, go back to those two objectives that you're trying to achieve in your portfolio, return perspective is, can you improve the return outside of what you already know about return? And the other one, can you accommodate the investor desire to invest sustainably? What are some of the issues with this data? What are some of the things that you should be really careful about? Well, coverage is important. How many companies are actually in a position to properly measure carbon output? So, like I said at the start, there is an enormous amount of, if you think about a global equity universe of 6,000 companies, or 7,000 companies, there's an enormous amount of smaller cap companies that just do not have the resources to measure carbon output. Measuring carbon output on itself is subjective, and you need a lot of the larger companies have internal teams doing it. A lot of the larger companies can hire consultants to come up with that emissions number. But if you're a small company, you're trying to grow your business, you're just not going to allocate resources to these. So coverage is something that definitely it's worth taking into account. And then even if you can measure the output, even if you can get that emissions number, what risk is that to your business? That's the other thing that is very difficult to ascertain. I mean, is it some assets that are just are really strong emitters of carbon and therefore they're stagnant? Is it the type of a specific part of your business that's particularly harmful to the atmosphere, or should you isolate that business and then get rid of it or replace it? So all these risks are very difficult to actually determine and quantify, and whether these businesses are willing to do that is who knows. Then there are many assumptions. We've spoken about this a few times now. When you're actually measuring these things, sometimes if you're a coal burning energy producer, for example, you might do something as simple as get a piece of coal that you're burning and take it to a consultant, and they might burn it themselves, a little piece, and extrapolate that the emissions number across all the coal that you're burning every year, for example. That's a pretty naive way to do it, but businesses do that. That's a pretty cheap way to do it. Or if you want to get an accurate picture, you might set up some sensors to actually detect the type of gases that are coming out from you burning the coal and the mixture of those gases, and use a proper methodology, a scientific methodology to determine that emissions number. But then do you do it just on a single day and then multiply that by 305 days, or do you keep those sensors on for a week or a year, or so there's all these considerations when you're measuring this data. These things, and obviously the more accurate you want to, the more accurate, the more cost it's going to have. So, what are the incentives for the businesses to actually do it? Yes, there is a strong amount of encouragement from the shareholders. There's a strong amount of encouragement from the regulators to do this. But at the end of the day, the shareholders are there to earn a return first and foremost. So who knows how much resources these businesses are spending on these things. Then finally, how far back does the data go? And this is really around that first objective about can this piece of information, can this sustainable data, can we extract information from that to tell us something new about what drives return? And in order to do that statistically, we're talking about other people's money here. So in order to really move your portfolio or change your portfolio based on this set of data, you need a good, reliable set of evidence. And that generally should go back, in order for you to draw any conclusions, that should go back decades, that set of data, rather than 4, 5, 6, 7 years. So you need a good, robust set of data that goes back a long way. Is greenhouse gas emission intensity the right measure? So we saw there's other considerations there, like water and waste management. For many people, that might be the main. That might be even more important, right? So again, prioritization is very important. There's no doubt that carbon risk is by far the biggest issues for your average shareholder. We at Dimensional, we subscribe to many environmental bodies around the world, UN, PRI, and we very much listen to what they have to say. And there's no doubt that that's the primary issue there, but it may change in the future, right? There's something else might come to be just as important, and we need to be able to set up a process that is robust and that could accommodate that change, and that could deviate the portfolio accordingly. Then there are other things like overlap between E, S, and G, and how do you capture that systematically? There was a few years back, I don't know if you recall, in Brazil, had one of the mines in Brazil, Cerramco, I think it was called. There was they put the waste from that mine aside into a dam, and what happened was that dam broke, and all this toxic waste spilled towards where the people kind of live, and a whole bunch of people died. I'm sure you read about that. So what you're saying there is you have an environmental issue that has now become a social issue, and ultimately also something that's become a governance issue as well, because clearly they didn't, as a business, clearly they didn't have processes in place that made sure that the dam was of high enough quality to maintain that amount of waste. So how do you, there could be an enormous amount of overlap there between the three, and how do you capture that systematically is the final, is a really important consideration. And then, with social screens as well, that's particularly problematic around the fact that at which point, is it E, is it S, and at which point of the supply chain cycle do you penalise, or do you take that into account? So think about factory farming, for example. Obviously, it's an environmental issue when, for example, chickens are being mistreated and being fed all these things, hormonal things, and they're through burping and farting, they're polluting the atmosphere. So that becomes an environmental issue. But then it's also a social issue, because there's some really people with a very strong view about animal cruelty as well, right? So which one is it? So you need to that can have an impact. What you consider this factory farming as, whether it's social or environmental, will have an impact on your portfolio ultimately. So you need to make those decisions and make sure that they're consistent. And then finally, at which point during the supply chain? You may, for example, a weapons manufacturer, you obviously want to downweight or exclude that company because there's a social risk there. But what do you do with the company that generates iron ore that these weapons manufacturer ultimately buys to build these guns and what have you? So at which point in the supply chain do you penalise? So that's also a really important thing when you're thinking about your social consideration in your portfolio. And then finally, well, not finally, but we've pretty much focused this conversation on equities, because that's kind of my bread and butter. But fixed income is a whole different field. It's in theory it's easy to say that you can just that if it's a company that you're excluding for a social reason, for example, if that company has issued bonds, then you want to be excluding those bonds as well. In theory, that's quite easy to get your head around, and it is that easy. But in reality, when you're working with data, that's a very difficult thing to do. To link equities to bonds is very difficult. Any company can issue many different bonds. Then there are situations like you can have Ford, the company manufacturer, and you can have Ford Finance. And from a linking perspective, when you're trying to link an equity to a bond because you want to be excluding that bond because the issuer is not sustainable for whatever reason, that's a very difficult, data intensive. We had people sitting for months carrying out this project before we launched our fixed income portfolio sustainably. So that's very important too. All right, so hopefully that gave you a bit of a feel for the type of data that we're working with and some of the challenging is and how it fits into the whole systematic portfolio management. I want to quickly finish off with a couple of little snippets of some of the literature that we've reviewed over the years, particularly, before we launched this suite of portfolios 5 years ago, but since then as well. We're obviously a very academic manager. We have a very large internal research team. We have very strong ties to their community, to the academic community as well. But essentially so we reviewed a whole bunch of literature. Like I said, there's a lot of papers written on this field. The three main conclusions that we come to is at the top there. The first one, the evidence suggests that ESG considerations are reflected in the price. So there's numerous tests by numerous people that have been carried out to prove this. The one in red is a really interesting one that I wanted to quickly talk you through. There is a journal called Nature. A lot of you, I'm sure, are familiar with it. It's a very heavily cited journal. When you write an article or a paper in that journal, you've really made it. And Griffin Jaffe and his colleagues there, names Dominguez Fowles, they ran an experiment. They basically ran an event experiment. The first experiment, they published an article that's basically after the Paris Accord, the 2050 Accord that came out in 2015. They published an article basically saying that any oil producing companies, if they want to abide with this accord, it essentially means that half of their reserves are going to be worthless. They won't be able to use half of the reserves that they got in the ground. So, and what you saw, and the moment that article was published, so that's event one. The moment that article was published in that really well-cited paper, Nature, the stock prices of those oil-producing companies that were mentioned in that article fell very hard on that day. Now, for whatever reason, then 3 to 4 years later, that was event number one. These same authors kind of published these articles in various other media outlets. Interestingly, while they published it 3-4 years later in all these media outlets, there was no change to the prices of those companies. So what this is trying to tell you, and what they were hoping to prove, and I think they've proved it, is that information gets into the price very quickly. So the way you govern your company, the way you disclose information, be it about your board, your governance, be it about your climate risk. This is public information, and investors know about all these things, and they take that into account when they buy and sell security. So it gets into the price very quickly. There's various other things that are various other pieces of research that prove that as well. Studies document mostly positive correlation between ESG variables and company financial performance, and that's pretty intuitive. Babchuk, Cohen, and Wang. Babchuk is actually a really popular guy because he maintains this G index and E index, where G index, for example, is where he looks at a whole bunch of companies and he basically he lists a whole bunch of governance issues like independent board members, no poison pill, proper remuneration, and if they don't stack up well on those issues, he puts a cross against them, and he basically produces an index for every single company in terms of how well governed it is. And you can use that index to then, run some regressions around performance of those companies. And what he found doing that, carrying out that project, what they found is that there is a relationship between governance and profitability, which is intuitive, which makes sense. Again, it goes back to that whole conversation about having the resources to govern yourself properly. But again, if you're a systematic manager, would you rather use the profitability information, which has been around for 70 years and the information is very standardized across the world and very readily used, or would you use the governance information to improve your return? Obviously the former. So that's an interesting one. And then finally, last one is no reliable evidence on the relation of ESG as a driver of returns after controlling for price and profitability. So again, remember that first objective was about to see whether we can outperform outside of what we already know using sustainability data, and all the evidence at this point in time, there is no strong evidence to tell us that that's the case. So if most of the experience that you do tell us that size, value, profitability, momentum, the things that we have known about for a long time, things that we have been measuring for a long time, explain sustainability as well. And that's really brings me to wrap up. And I really just wanted to, I guess, I'll say thank you for your time first and foremost, but also the main takeaways is that there is definitely a rapid pace of improvement in terms of the quality of data and the coverage, which is a great thing. So this set of data that we're working with is going to get better and better, which is really important for portfolio management, for systematic portfolio management. There is an enormous amount of motivation for businesses now to disclose how they measure ESG issues and how they address them. So that's very good. At this point in time, our view is, or my view is that data is still, it's a very short-term data still. We've got probably 5 to 10 years of okay coverage. And there are still many inconsistencies that you need your process to be able to accommodate. The good thing is that there are more and more data providers. Like I said, when things become popular, like anything else in life, there's more people that are trying to, commercialize the popularity, and there are more data providers. That means more competition. That means better outcomes, lower fees, more access, and better quality ultimately. So this is a very good thing. Competition is a good thing. But ultimately, have we solved the two problems? And definitely the answer is yes to sustainability. So there is enough, the data is good enough now for you as an investor to systematically invest in a sustainable manner. There is no doubt. We now have enough information to tweak your portfolio to make sure that you exclude some of those companies that screen poorly from a social standpoint. We can exclude companies that are big emitters. We can downweight and overweight. We can systematically produce these portfolios that achieve both of these objectives. They can outperform for reasons that we've known about for a long time, like value, size, profitability, etc. But at the same time, they can accommodate that desire to invest sustainably for an investor as well. And with that, I think I went a little bit over time, but I think we started a bit late as well. Spoke a little bit too long as per usual, but thank you very much for your time.
Thank you, Slava, and thanks everyone for your questions that have come through. We do have a little bit of time. I do apologise if you do need to run. Obviously, please do. However, we have a little bit of time now to answer a few questions, given that we did start late. I will paraphrase them a bit, Slava, because Bjorn asked a great question.
Make them easier, please.
Yeah, he asked a great question, and I think you partially answered it. But there is actually, rather than just excluding a company, there have been cases where people use the data to then manage the risk and do something themselves to offset the social factor or the environmental factor, and we have heard from that previously.
Yeah, if I understand the question correctly, that's a governance kind of question. I feel there is no doubt. What the way to approach is that, again, like I said, governance. Whether a company is well governed is very much in the price. It's public information. But as a shareholder, you should absolutely encourage the company to improve their governance practices, because if you can remove some of these conflicts, force or encourage the company to remove overcompensating their executives, for example, or if they are mismanaging carbon risks, to get them to disclose that properly and manage it properly. All those things should translate into a high price ultimately, and that's obviously good for everyone. So absolutely, you can screen out the bad ones, but you can also work with those that need improvement.
Okay, and an allied question was, even if there was only a small percent in some of those indices, if you advertise as an ethical and sustainable fund, then obviously you still need to screen them out, don't you?
Definitely, absolutely. It's more just from an internal processing perspective. How often do you review those screens? How often do you review those companies, and all that type of stuff that you need to take into account, given it's such a small part of your portfolio. But absolutely, yeah. If this is what you're doing in your portfolio, if you're trying to manage money sustainably, then you need to screen those companies out, definitely.
Okay, and also another question about returns, and you again, you've kind of answered this.
Yep.
How do you differentiate between systematic investing and sustainable investing? And in portfolio management, does sustainability mean low risk return returns for the investors?
I'll answer the last question first, and the answer is our research shows otherwise. our research shows that companies that are not sustainable or less sustainable tend to have a higher expected return. They are riskier. Again, that evidence is not strong enough for us to do anything with it in our portfolios. But what we're offering essentially is you can systematically produce a portfolio that is there, that will outperform for things that we've known have outperformed for many decades. But at the same time, we can also set that portfolio up to be a sustainable portfolio by, for example, going into the energy industry and overweighting energy companies that try to extract energy in a sustainable fashion and reward those at the expense of the ones that are on the other spectrum of that, and do that within every sector. So you maintain diversification, but you penalize those companies that score poorly, you reward companies that score well. So you can achieve outperformance through size, value, profitability, but at the same time you can have a sustainable portfolio.
Okay, thank you. And also a question here about, you say the data is now good enough. In your view, how far back is the data not good enough, and how far back can you simulate?
Well, look, like I said, the suite of portfolios that we manage with this new approach reliant upon this data goes back about 6 years. So I think there's probably something between 5 and 10 years worth of data that can probably get you a reasonable portfolio, but it's improving very fast. You need, if you wanted to achieve that first objective, which is if you wanted to move your portfolio towards outperformance due to sustainability data, you need decades to have proper reliable evidence. You really do, because it's other people's money that you're managing ultimately. But the amount of data that we have now from a sustainability standpoint is enough for us to achieve sustainability in our portfolio, not necessarily return.
Okay, thank you. The last couple of questions are really about the social investing screen that you have. Someone here Michael Dwyer has noted that financial services is missing, although we've had a Royal Commission which has listed some bad behaviour. Might be a case for including other domains, companies, as well as being unethical. Ethical investing seems to be an ambiguous area with no clear or widely accepted definition.
Yeah, absolutely. We address things like Royal Commission, we address that through governance. So rather than, again, if you're a systematic investor, diversification is very important. You don't want to be, there's a very large bar for you to exclude a company altogether. So what we do with companies like AMP is we try to, again, through governance, we try to vote proxies, try to engage with their boards to make sure that they improve those practices. We may have something in the process that, post Royal Commission, for example, it was very clear that AMP wasn't going to be anywhere near as profitable as it was before the Royal Commission for quite some time. So you need to make some adjustments to the information, to your portfolio there from that perspective. And then you want to go out there and engage with the company to make sure that you understand what's happening and make sure that they're improving. You may team up with other shareholders as well to do that. It helps being a large manager, it helps being an influential shareholder. So, but yeah, it's, again, yeah, that's sort of how that process works.
Okay, thank you. And then finally, one more last question from Anthony Kaur, who is our presenter for next week. He's said that here almost 2% of the countries in the MSCI All World engage in child labour, and that is the market capitalisation of Australia. Do you know what kinds of businesses these are?
Yeah, it's actually the chocolate producers. They're the largest ones. So Lindt and Nestle, they're the ones that we exclude for child labour. They've got, I think it's predominantly in Africa. There's some in South America as well. They get kids, collecting all the cocoa leaves off the farms. But then again, like that's a really tough one too. The social ones are the most problematic in terms of getting the right interpretation, because it's like the premise there is, instead of working, this child should be at school. But then, if that child comes from a very poor home and he's the only one that could make the money to feed his family, then, is that the right decision that we're making as well? So there's so many layers that you can peel before you get to the actual. So it's very, very tough, very problematic. But yeah, that's a really good observation. That 2% of the world, which is the equivalent of Australian market cap, is excluded for that reason. That's quite stark if you put it that way.
It's a fascinating area, and one which I know will get a lot. There's standards coming out all the time, discussions about future standards. So it's going to continue. So thank you very much for that Slava, I'm sure everyone got a lot out of that. There's still quite a few people still hanging in there. Thank you, guys. We will let you go now. So thank you. Just remember that next week, on next Wednesday, is the final in this series. Anthony will cover some of those questions about data and the need to make sure that you've got the right data and it's in fit purpose. So I look forward to welcoming Anthony next week and seeing as many of you as possible back there then. So once again, thanks very much, guys, and we'll see you next week.